I don't know if you have any thoughts on Greenspan.
Look, Greenspan lowered rates to 1% and quit. They have 2.5 quadrillion yen of debt, total credit market debt. For those of you that don't know what a quadrillion is, it's 1,000 trillion. How many of you want to make a 30-year loan at 3.5%? I will never make that loan, right? And keep it on my balance sheet.
Hi, my name is Greg Magadini. I'm the Director of Derivatives at Amber Data. I have 15 years of derivatives trading experience and a background in proprietary trading. Today I want to talk about the situation that the Western world finds itself in. Some might call it the debt supercycle. But I want to specifically focus on Japan, which is sort of the most advanced country in this situation. To give credit where credit is due, I became obsessed with this macro situation in Japan since I first saw Kyle Bass's AmeriCatalyst interview back in 2010. In this video, we're going to talk about the macro situation, some trade structures, some of which I've kept secret to myself until now, and then what would I do if I was a policymaker in Japan and what I think a potential solution could be. This is sure to be controversial, but these are just my opinions and my thoughts that I want to put out in the universe to share with the world. Okay, so let's recap the macro situation. Today, the G7, or the Western world, finds itself in a situation that a lot of people are calling the debt supercycle. This is essentially where, after a financial crisis, private sector debts were assumed by the public sector and now reside on the public sector balance sheet that are now being financed by central banks. Essentially, it's sort of rolling the snowball of debt from private sector all the way through to fiat. One of the very interesting things about Japan is that Japan had its financial crisis 16 years before the 2008 financial crisis. And Japan, being the world's third largest economy after the US and China, also has the world's highest debt to GDP ratio. Japan's debt to GDP ratio today resides at about 265%, which is nearly twice as big as the second most indebted country, which is Italy, at around 140%. So it's way more advanced on this trajectory than the rest of the Western world. Why is that bad? Well, today, Japan's tax revenue is about 13.5% of GDP. With a debt to GDP ratio of 265%, that means that if the on-balance sheet interest rate, or the interest rate that the government actually had to pay, were only 5%, 100% of tax revenue would need to go towards paying interest alone. That means there's no money for pensions, no money for welfare, no money for military, which is a growing risk, no money for regular public services. That's essentially what Kyle Bass calls the Keynesian endpoint. And it's just sort of the terminal end of this situation. Traditionally, countries try to fix this problem via two paths. The first one is to grow GDP. If you grow GDP, then the debt to GDP ratio diminishes because of a larger denominator, but also you have more tax revenue because you have a growing economy. The second situation is the more controversial one, which is debt monetization. So I think it's really important for us to visit how did Japan get in this situation from a brief perspective. Japan was a really fast-growing economy, and it grew so fast that it ended up becoming a bubble. Essentially, they called it the bubble economy, where asset prices just inflated extremely high, and people would say that at its peak, the value of the land underneath the emperor was worth more than all California real estate combined. Just to give you an idea of the magnitude, I don't know if that's totally true, but just to give you an idea. Well, in the early 90s, that bubble burst. And what happened is, when a bubble like that bursts, consumers and the economy itself go from a net positive asset balance sheet to a negative asset balance sheet. So what that means is that people are not able to sell their assets to extinguish their debts. they sell their assets, but it's not enough, and so there's still debt outstanding. The consequence of that is that demand gets stripped out of the economy because people spend their discretionary income paying down debt instead of helping grow the economy by buying goods and services. Producers, on the other hand, will hold their output constant, theoretically, in order to try to grow their way out, and so it causes a deflationary cycle. As demand drops but supply stays constant, price needs to drop in order to meet supply and demand. The natural response from the Central Bank of Japan, the BOJ, was to cut rates down to zero. Essentially, the BOJ was the first mover in terms of cutting rates down to zero. The idea here is to lighten up the debt burden. This wasn't enough to spark growth and fix the situation, however, so the BOJ started to improvise. The BOJ is actually the central bank that invented QE. They invented it and launched it in 2001, and their idea was to try to stimulate the economy beyond just cutting interest rates by doing quantitative easing. Unfortunately, that didn't work either. But there was a secondary effect that did happen from all that central bank activity, and that is that it lowered the cost of government borrowing. And it allowed the central government to continue to issue more debt, trying to spark the economy themselves, grow their budgets, grow deficits, and essentially layer on a higher debt to GDP at a lower cost because the cost of debt was essentially nothing. Okay, there's an interesting aspect here from having lower interest rates in Japan than the rest of the world, and that's the yen carry differential. The interest rate differential between the yen versus the rest of the world became that it was cheap to borrow yen to buy higher yielding assets or higher yielding foreign assets and foreign currencies. They call this the carry trade, or the yen being a funding currency. Now, this actually didn't really destroy the value of the yen as many people think it would, because there's still a lot of external demand for Japanese goods, and Japan was a net exporter of goods, which created buying pressure or international trade bid for yen. And so in consequence of that, the Bank of Japan was able to amass one of the largest FX reserves globally. Essentially, today the Japanese FX reserves currently lie at about $1.2 trillion. There's another aspect that continued to prop up the value of the yen as well. Not only was the yen a net exporter, but globalization, which helps support net exports, also decreased the cost of production worldwide, which is a deflationary event. And so post 1970s inflation, and really peaking in the early 80s, we have had 40 years of a bond bull market, which essentially means that there's a global convergence of rates falling down to Japanese levels. So the yen differential has been collapsing and converging for essentially the past 30 years now. This brings us to the Great Financial Crisis. The Great Financial of 2008 essentially had the same response in the US and elsewhere in the world that we saw previously in Japan. Central banks cut rates down to essentially zero and started experimenting with quantitative easing. Post-Great Financial Crisis and central bank activity, the yen rallied pretty strongly from 2008 all the way to 2012. Now, despite this demand for yen, something else is interesting. The Japanese economy didn't recover as strongly as, say, the United States economy and some of the other Western countries. And a lot of that is due to structural reasons. This brings us to the election of Shinzo Abe. Abe ran on the platform of Abenomics. Essentially, it was a three-pronged solution to try to restart the economy of Japan and fix some of these structural problems. The first solution was to double down on monetary policy. The second solution was to increase fiscal spending, offset by some tax hikes. And the third solution, or the third arrow, was to do structural reforms such as joining the TPP. Those effects didn't work well enough to spark the economy again, but it did devalue the yen a lot. The yen lost a lot of its value as monetary policy went to negative interest rates, more QE, and in 2016 introduced a policy of yield curve control, which is essentially a way to get yields down across the yield curve as opposed to just the front end. Now the interest rate differential was once again really big. So now where are we today? Despite the massive moves in Abenomics and the subsequent devaluation of the yen, almost nothing compares to the COVID-19 crisis. In response to the COVID-19 crisis, we had two reactions. Global monetary policy around the world essentially doubling down, where central banks' balance sheets essentially grew by 100% from an already extremely historically large level. And two, the effects on the supply chain caused global supply of goods to diminish by drastic amounts. Remember earlier when we talked about post-asset bubble burst, that demand was diverted away, but supply remained constant? The response to COVID is the exact opposite. Monetary policy and fiscal stimulus help continue to drive demand higher, while supply chain shocks reduced supply simultaneously. So this created a spark of inflation that we haven't seen for decades. Can Japan really continue to be an island of low interest rates when the rest of the world is raising interest rates in order to combat inflation without having a break in the yen? Okay, so here's what I think the BOJ Endgame is. The first thing to note is that betting against Japanese government bonds, or JGBs, is dubbed the Widowmaker trade. The reason why that is because I'm not the first one to notice a high debt to GDP ratio in Japan. Even when the debt to GDP ratio was only, say, 180%, people thought that was too high, and at some point Japan was going to default on its bonds. Well, Japan has never defaulted on its bonds in recent history, and people who were betting against JGBs essentially lost their shirts, lost their jobs, and essentially, this is why we call it the Widowmaker trade. There's another interesting aspect about Japanese bondholders, or JGB bondholders, which is that most of the bond holdings of JGBs are from the Japanese themselves. So even if, say, the BOJ wanted to raise interest rates, there would be a twofold effect. One is that higher interest rates would slow down the economy when they're essentially trying to spark growth. But two, the net present value losses of owning, say, a 50 basis point 10-year JGB that should now be yielding 350 basis points will be concentrated within the Japanese economy itself. So all the pain would be felt internally as well. Remember when SVB went broke? Essentially, SVB owned a bunch of US Treasuries on its balance sheet, and the Federal Reserve raising interest rates made it so that the net present value of those US Treasuries, those losses essentially wiped out the capital structure of SVB. And SVB had to be taken over by the government, and in response, we had the Federal Reserve essentially creating an emergency loan program where regional banks can now post treasury bonds at present value and get a loan at face value. So essentially putting the net present value losses on the US central bank. Even though they say it's a temporary basis, time will tell, it's the same problem. Here's what I think the BOJ endgame is then. I don't think the BOJ really wants to raise rates. I think what they want to do is to quietly and slowly amass all the JGBs that are outstanding in the market. They're just going to keep buying them. And as long as the yen doesn't break, they can continue to circle up all the JGBs out of the economy and put it on the central bank balance sheet. And they can continue to finance government deficits. In our current fiat world, central banks have learned that they can control the bond market. What they can't control is fiat currency value. Therefore, non-linearity is going to reside in the yen. non-linear opportunity resides in the yen. It doesn't reside in the JGB market. Instead, what we're going to see is what we've seen recently, which is rate hike light, where essentially the BOJ might talk up interest rates, say, increasing a little bit of the band of the yield curve control. So 10-year JGBs might yield 100 basis points instead of 50 basis points, but they're not ever going to let go of the low interest rate policy. And if they don't need to let go of it because the yen holds its value, then they can just continue modus operandi. In my mind, that's the BOJ endgame. The problem with trading big paradigm shifting events with non-linear inflection points is that it's very hard to see or spot those inflection points ahead of time, and timing is crucial. One way to mitigate this, or essentially a crucial component of a trade structure in this case, is that the trade itself must be positive carry. That way, while you wait, you can generate income and afford the opportunity to wait for that inflection point. This leads me to the trade structure that I find very interesting, which is a risk parity type of trade between US cash treasuries and Japanese yen futures or Japanese yen forwards. The first leg of this trade is the Japanese yen. Essentially, shorting the Japanese yen, the biggest risk that I see is that the world goes back to global recession. If we go into global recession, we can expect central banks across the world to respond by lowering interest rates again, essentially collapsing the interest rate differential between the yen and, say, the US dollar. This would be a cause for the yen to rally, which is the biggest risk that I see to the short yen leg of the trade. Now, one of the first things that are very interesting about the short yen trade is that if you look 1 year out to the currency forwards or the currency futures, you can see that the 1 year out future trades at about 5% premium to the cash price. And this really reflects the interest rate differential. That means you could short a yen future 1 year out and naturally earn about 5% carry as the yen future decreases in value down to spot prices. Hedging the risk out of the first leg of this trade can be found by actually going long US Treasuries. US Treasuries right now yield about 5 to 6% depending on the maturity that you're looking at in the short end of the curve. Now, what's really interesting here is that given the macro situation we just described earlier, there's two ways that the interest rate differential between the yen and the dollar could collapse. One is US interest rates collapse in response to a recession and the Fed lowering rates. The other one, theoretically, is that Japanese yen yields could increase, which also collapses the differential. Even though interest rates are high in the US, if Japanese yen interest rates increase, then therefore the collapse of the differential should cause the yen to rally. Now, because we just described the current Japanese macro situation, I'm making the strong assumption that I don't think rates in Japan can go up at all. So taking that scenario off the table essentially means that pairing a US Treasury bond versus a short Japanese yen future enables you to earn, call it 5.5% on each side of the trade, so a total positive carry of about 11%. And should we go into recession, the rally in US Treasury bond should offset losses in Japanese yen futures, and should inflation continue to be persistent, then the drop in Japanese yen futures from a widening differential should offset any losses on the US Treasury side. So together, you can essentially straddle both scenarios, and it allows you to maintain exposure to the Japanese yen should nonlinearity occur in the depreciation of the yen given the macro situation. If you want to leverage up this trade, you can actually take the Treasury side of the trade and go further out in the duration by going further out along the yield curve and essentially allowing you to leverage up more short Japanese yen futures, increasing the total carry of the trade. Now, the way that I would do this is I would look at the correlation between Treasuries and short yen, and I would also look at the volatility between both assets. The last really interesting property about this type of trade structure is that when we're talking about FX and US Treasuries, we're talking about the most liquid markets in the world. So this is the type of trade that not only provides an interesting return profile, but it's extremely scalable and can maintain a lot of size and allow traders to get in and get out with relative ease and manage a large portfolio. Okay, the second trade that I find very interesting right now really is embedded between the relationship between future options implied volatility for yen futures and the interest rate differential between dollar yen. If we look at historical implied volatility of yen future options, it really lies between 5% annualized to 15% annualized, and today we see it at around 9% annualized. However, the premium in the term structure due to the interest rate differential is about 6%. Now, why is that important? Future options trade on their corresponding future, meaning that a 1-month option trades usually against the 1-month future, and a 1-year option trades against a 1-year future. Now, normally, spot or cash market volatility isn't necessarily a good proxy for long-dated volatility. You see this a lot in VIX futures. Think about VIX futures for a second. Long-term VIX futures are really going to be anchored closely to long-term median vol, while short-term VIX futures or cash VIX is very subject to right now volatility, and so it can flip from contango to backwardation extremely quickly. So you could see a rally of say 100% in the front month future in VIX futures, but essentially barely any movement in long-dated futures for VIX futures. This means the dynamics of the term structure are extremely fluid and flexible. You can see the same types of dynamics in commodity futures as well. Remember when COVID-19 made oil go negative? Well, front month oil delivery or immediate delivery was negative because there wasn't any place to store oil today, right now. But longer term oil futures, 1 year out, 2 years out, was anything but negative. It reflected more normal supply-demand dynamics and didn't move as drastically because right now delivery of oil isn't necessarily fungible to 2 years from now. There's a lot of storing and holding and moving through time to get it to 2 years out. So the dynamics of the term structure in commodity futures as well is extremely fluid and subject to kinks and different backwardation and contango cycles. Now this brings us to financial instrument futures and forwards. Now the thing that's very interesting about financial forwards and futures is that outside of carry costs, financial instruments are a lot more fungible, which means that the term structure is a lot more rigid. 2022 had one of the biggest interest rate hike cycles in the United States, and what we saw is that the yen crashed a lot in response. And although the term structure steepened, there was a parallel shift lower in the value of the yen across all expirations. So why is this interesting? Well, the opportunity that I see here is that you can actually buy at-the-money options 1 year out on yen futures that, all else held equal, will actually expire in the money by a greater intrinsic value than the extrinsic value you paid on onset. Essentially, it means that the time decay of the option is offset by the futures roll down or the interest rate differential that currently occurs. This type of situation is not an arbitrage, but there is a lot of value there. Essentially, it allows you convex exposure without needing to pay for it. Again, all else held equal, the futures price roll down to spot will be by a greater magnitude than the implied vol or the extrinsic price that you paid in terms of vol for the at-the-money option. This type of situation is rare because it has two really important components: a low volatility asset class and an extremely high interest rate differential that's being priced into the term structure. And unlike the VIX or commodities, should the value of the yen change, the term structure is not as fluid. The back end will also move in a near parallel fashion. Not exactly parallel, the front end will move more, but in a near parallel fashion. So that's the second trade that I find really interesting, is long dated future option puts on the yen. Okay, I know this video is getting long-winded, but I still have a couple more thoughts. The first question is, what would I do if I was a Japanese citizen in order to protect my assets? One of the most interesting aspects to me is the ownership of Tokyo real estate, specifically Tokyo mini mansions with land ownership rights. Real estate is a productive, tangible asset. So should there be a devaluation in the yen, while the value of the land itself will just be worth more yen. So it's a preservation of wealth. The second really interesting aspect of owning real estate in Japan as a Japanese citizen is the availability of long-dated mortgages at fixed rates. For example, you can get a 35-year fixed rate mortgage between 2 to 3%, which is extremely low, and it fixes your costs in a way that's very predictable and manageable. Should there be any sort of inflation, then having fixed rates on the mortgages of your real estate affords you a really interesting opportunity. Rents theoretically can go up while your costs remain fixed. Now, Japanese real estate does have a peculiar aspect that we're not used to here in the United States. The value of the structure itself, or the building, is expected to depreciate through time, not appreciate. Although land itself is expected to appreciate, or that's my understanding. So I don't know where exactly that comes from, whether it's a cultural phenomenon or whether it's a relic of a deflationary mindset. But if it is a relic of a deflationary mindset, then the present value of a long-term depreciating asset flipping into appreciating mode creates a huge differential should that occur. Okay, another quick thought. When we talk about investing in real estate, horizontal land is of a limited supply, but vertical land is of an infinite supply. So when I think about investing in real estate, I want to own land. You want to essentially be a landlord, not a box in the sky lord. Therefore, condos within big high-rises are not a really interesting investment in my opinion. Multi-units with land ownership rights are the most interesting asset in terms of real estate investing in my opinion. Now, here's one last thought. Japan has a declining and aging population, and historically the solution to a declining population is net migration. Now, I don't know if Japan's ever going to pursue that solution of net immigration, but if they do pursue that solution of net immigration, while taking the biggest city in the world, which is Tokyo, in a very densely populated country, which is Japan, and adding net immigrants is going to create a non-linear demand for Japanese real estate. Tokyo is extremely safe, it's extremely clean, it's extremely vibrant, and it's the hub of the third largest world economy. There's a lot of value there in my opinion. Okay, here's the section that's going to be controversial, but I don't care. Although Japan has a high debt to GDP ratio and is in deep financial debt, there's a lot of things that Japan does have going for it in terms of culturally and in terms of financial infrastructure. Financially speaking, Japan has one of the largest FX reserves worldwide, which sits at about $1.2 trillion. $1.2 trillion versus about $13 trillion of debt actually improves if you kill the yen. If you kill the value of the yen, the FX reserves to debt ratio actually improves in your favor. But the FX reserves provide one more really interesting opportunity. It provides Japan the flexibility to invest. Currently, the Western world is in a fiat trap, and we're actually starting to see BRIC countries looking to start a hard money cycle backed by gold. Now, I personally think the hard money cycle backed by gold is still looking backwards. The real interesting opportunity is to move forward in digital hard money. Japan actually has the opportunity to be the first mover. Let's just say, for example, that Japan uses some of its FX reserves, say 300 billion or 500 billion, to buy Bitcoin. It can solve a lot of its outstanding problems all in one shot. Firstly, owning hard money, in terms of owning Bitcoin, is a really interesting proposition on the Japanese balance sheet. But what's even more interesting is that Japan has a very skilled workforce and a very sophisticated financial infrastructure stack. Here's my trail of thought. Should Japan actually buy Bitcoin and then pioneer the development of the crypto industry, it would actually be bootstrapping one of the highest growing industries within its economy. Another interesting aspect is that because Japan is a homogeneous society, it can actually communicate these efforts very efficiently throughout the population and essentially get more people on board quickly into this new type of thinking. Two more quick thoughts. If Japan became the world hub for cryptocurrency development, it could actually attract highly skilled labor as net immigrants who want to develop and start companies within Japan, once again bootstrapping growth but also growing the declining population. And lastly, if Japan succeeded in pioneering the cryptocurrency sector and developing the sector at mass scale, it actually increases the value of its own holdings that it bought earlier as a start of the effort. Here's the analogy that comes to mind. It's almost as if the G7 countries were all families looking to buy houses next door to each other, and Japan had the opportunity to pick the ugliest house on the block. But also, all the family members within the Japanese household are expert plumbers, expert roofers, expert painters, expert interior designers. So not only do they have the skills to fix up the ugly house, but they employ themselves while doing it, and then they also add value to the house itself. And by buying the ugly house and fixing it up, it actually makes the whole block worth a lot more. That's the analogy that I make. Now I know this is really out there and sort of a wild card, but this macro situation has been persistent and deep for a long time. And this is the only solution that I can think of, so I'm just putting it out there in the universe. Anyways, thanks for listening to my ideas. Check the link below to download the chart book. And for anyone interested in CryptoVol, check out some of our reports linked below as well.